Earnings season looks to kick off in the coming week with a big focus on the banks once again. And the financials really do look to be in a potential sweet spot. I'll explain exactly why in this video and also give you an overview on what's to come from a sector specific basis and also for the S&P 500 as we move into the fourth quarter earnings season for US equities. So, first and foremost, let's look at from a wider perspective the way that things have changed in terms of expectations for the S&P 500 earnings. What we can see here with the data from FactSet is that essentially we have seen downgrades to the tune of 2.7% in terms of expectations for earnings from the S&P 500 as a whole. That means that we're coming into it with a lower bar. And generally, we've seen in the past this ability to massage expectations to the low side, and then that builds the opportunity for businesses to be able to outperform. We're seeing it once again here. And whilst you might say, everything that's happening within the markets at the moment in terms of the concern that we're seeing, some of the jitters we're seeing, the rise in terms of treasury yields and borrowing costs, those concerns, that is not what's translating into this minus 2.7 in my mind, because you can see that it's happened time and time again in the past. This is something that generally does happen leading into earnings season. We're seeing it once again here. And by and large, I think it is a positive for stocks as we go into a period where hopefully we therefore have a number of companies managing to beat estimates when it comes to earnings per share. In terms of the revenue side of thing, here's a breakdown in terms of the expectations of who's going to do best and who's going to do worse in terms of sectors. We can see that on the top end, we're seeing IT, so big tech expected to continue outperforming here. Utilities, 8% growth expected. Communication services, again, that sort of wraps up the other half of the big tech names. And then healthcare, real estate, financials, consumer discretionary. The bottom end of this is energy, which by and large, we generally see energy names doing well or poorly, but basically that's generally reflecting the movements we've seen within the prices within energy space, energy markets itself, right? So, if we see weakness in the oil price, you're likely to see oil majors performing poorly that are reliant on energy prices. So we don't necessarily see huge volatility off the back of that weakness generally if it is predicted, and that's what is predicted here. But of course, we have seen a bit of a rebound recently in terms of oil. So the outlook will be important. Industrials and materials also at the bottom end of things. Interestingly enough, this time around, we are expecting to see 2025 being a year where we're seeing a slowdown in the pace of growth from big tech and those Mag 7 names and a pickup in terms of growth elsewhere within the market. That's something that we were expecting over the course of last year, and that transition is expected to really take hold over the course of this year, predominantly because on one side of it, you see big tech, and they've been growing at such a rapid clip with the whole AI adoption, huge spending that we've been seeing, boosting the likes of NVIDIA. But that's likely to slow down in terms of spending. And the question mark is whether they're able to push onwards and upwards and expand at the same kind of rate. Certainly the likes of Tesla, I would say, that's going to be a really interesting one, because we've seen so much upside off the back of the idea that Elon Musk is in Donald Trump's ear, and a lot of expectations, and these companies have to deliver. But elsewhere, the rest of the market, are we going to see Trump's policies benefit US stocks going forward? And does that provide the basis for significant strength when it comes to the rest of the market? Certainly, that's going to be a really key theme that we're going to be following over the course of the year. Then let's look at that earnings breakdown for each sector. So previously looking at revenues, now looking at earnings. Very interesting here is that no longer is IT top of the stack. They're in amongst it, right? They're third alongside communication services. So you can see here growth from those sort of big tech names expected to continue this time around. Financials are expected to be the big performer. Earnings growth of a whopping 30, is that 39, 38, 39.5. So massive growth expected. The bottom end is energy and industrials and materials once again. But this really brings us towards the fact that the coming week is going to be dominated by financials. Generally, earnings season kicks off with the big banks, and the first, I'd say, week and a half, because this coming week, generally all the action's right at the back end of the week. The first week and a half of earnings season generally sees a massive focus on financials. And that can be big banks, but that can also be the likes of insurance companies and alike. Now, from a wider perspective, why are earnings important for the market, right? You might say, well, I just trade the indices. I don't trade individual names, so I don't really care that much about how earnings seasons go. But bear in mind that the incessant gains seen by the S&P 500 and the fact that for, as long as we can look back, it has continued to push up and up and up and up and up, which can't be said for every single market. You can't say that for FX pairs. That's not always the case for commodities, but generally the reason that the S&P 500 moves up is because the underlying earnings growth. As long as earnings continue to grow for the market, that justifies ever higher prices for the S&P 500. Notably, though, what we've seen over the course of the past year is this divergence where we're seeing much higher growth in terms of the S&P 500, which is the orange line on the top end of this, compared to the earnings growth, right? So earnings growth has been towards the upside, but it feels like markets have got a little bit ahead of themselves on the idea that we're moving into this big pro-growth period where we're going to see rate cuts galore. We're going to see the economy really boom. And then Donald Trump came in and he's got this big focus on the economy. So again, equity markets gaining ground. But what we've seen is that outstripping in terms of the performance of the S&P 500 compared to the likes of the earnings per share of the index. And that's what provides what we can see at the bottom, which is the growth of the price to earnings ratio. And a higher PE means that it is perceived to be more expensive, right? It seems like it's a pricier market to be in at the moment. And it really does provide some caution about the possibility that maybe we won't see a 20% plus gain for a third year running. We might see things a little bit calmer. So let's see if Donald Trump can do that or not. So this is the breakdown in terms of the sort of top names that are reporting over the course of the week ahead. You can see at the top of it, JP Morgan Chase, UnitedHealth, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, BlackRock, Citi, PNC, US Bank Corp, Trust Financial, Boney, and Schlumberger. So a lot of big financial names. So let's pick through those. So I wanted to bring to your attention a couple of the sort of huge investment banks. And then I also wanted to talk about UnitedHealth, because I think that's a really interesting one going forward. So let's start off with JP Morgan Chase. This is a breakdown in terms of their revenues and earnings on an annual basis. So what can we see here? Well, the expectation over the course of coming years, which is generally what I'm looking out for here, is that we do see some decent growth in terms of EPS. Nothing huge. You can see certainly 22 to 23, we went from 12 to 16. Well, we're expecting 18, 17, 18, 19. Is this a question, or is this a case of a company that, has relatively low expectations that should be easy to overcome? Again, similar kind of thing. We are expecting to see some growth from revenues, but nothing too crazy over the years ahead. And then in terms of the quarterly metrics, we can see here 437 down to 408 expected. But if we look in terms of the year-on-year comparative, it's 304 up to 408. So that's pretty healthy growth there. And then if we're looking at the revenue side of things, the Q4 of the previous year was 38.57, this time 41.8. So again, strong expectations around that one. Now, ultimately, when we're looking at the likes of JP Morgan, Goldman Sachs and the like, so you can look at it from a number of different sides, right? But the reason why I think that this is going to be a particularly positive time for financials is that they have the benefits of higher for longer interest rates, because ultimately the Federal Reserve don't look like they're going to be cutting rates to the degree that people expected. And so the question mark is, will they have the the benefit in terms of improved margins from higher interest rates and high yields and borrowing costs, will that benefit be offset by weakness within the economy? If we were to see high rates leading to economic decline, then that would provide the basis for banks to possibly see significant losses. They'd have to write off a lot of their debt. You might see volatility within the equity markets that might damage some of the investment side of the business. But this time around, it feels like the strength in terms of yields is off the back of expectations of inflation in anticipation of a Donald Trump presidency that by and large is going to be focused on growth, right? So it's a case of saying, well, the economy might be so strong that inflation might be pushing higher. That keeps borrowing costs high because they don't have the ability to cut rates, because that might then stir inflation once again. So you have a double-sided benefit here for the banks, where you see a really strong economy and you potentially see high borrowing costs, which means they have strong margins as well. So I think banks are in a really good position. As we saw in terms of the expectations for the fourth quarter, the expectation is that the financials are going to be the best performing sector when it comes to earnings. And so the likes of JP Morgan, likes of Goldman Sachs, they're going to be some really interesting names to be looking into as we go forward. If we're looking at the chart here for JP Morgan, what I find really interesting here is the relationship between the US 10-year yield and the share price of JP Morgan. So what we can see here is we do spend periods where we are moving in tandem, and then we see periods where we are moving out of tandem. So we're essentially moving inversely, right? And notably, what we've seen here was we saw the increasing borrowing costs, right? So as inflation started to spike, so let's see if we can just put the Fed funds rate in here. So let's just put it into a new pane. So essentially, as inflation started to build, we started to see this inverted relationship between the 10-year and the banks, or JP Morgan on this occasion. Then we started to see the upside move in terms of interest rates. Higher interest rates should be beneficial for banks. We didn't necessarily see that. We saw the 10-year yield moving towards the upside, but the valuations for JP Morgan moving lower, because there was an expectation that this rise in terms of yields would damage the economy, and it wouldn't necessarily be as good for banks as people might believe. It's only once we then got into a point in time where people started to think, well, rates are elevated, but we're not necessarily seeing any sort of tangible decline in terms of the economy. That's when we started to see the possibility of them moving in tandem. We can see sort of divergence here, so inverse correlation, then moving into a positive correlation. Then we started to see a bit of a pullback, so then inverse correlation again, and now back into positive correlation. Because in my mind, what the banks are happy with is higher borrowing costs against the backdrop of a strong economy. What they don't necessarily want is higher borrowing costs against the backdrop of those borrowing costs really damaging the economy and damaging the business that underpins the likes of JP Morgan. So we're also seeing, of course, rate cuts, but by and large, the slowing of that rate cut, I don't necessarily think it's going to be super bad for this business. So that's sort of the backdrop to how we're looking at this chart. And so, you can say, well, if rates are cut at a slower pace, then it's good for margins. If rates are cut at a faster pace, they still have good margins, but it also will be good for the economy. So it's sort of a win-win in my mind. I think that the banks are very well positioned as we move forward. And so you can look at this sort of wider chart here. This is the daily time frame, and we're sort of picking through the major swing lows that are incorporating this trend. So you can just see them very clearly, and each one we're creating, although this is flatlining here, so you managed to come back to meet it. Each time you rally into a new high, you create that new higher low. And so we're just following this trend. And that trend, I think, is likely to persist for some time yet. If you look back at the best performing assets within financial markets under Donald Trump, financials were the best performing. And I expect to see similar outperformance as we move forward. We've pulled into this deep fib retracement beyond the 61.8, but just shy of the 76.4 fib. And now we've been sort of regaining ground. So look at it on the hourly time frame. We're sort of rebounding, sort of grinding higher at the moment. If we were to pop back down through support here at 237. Then we could come into a potential deeper retracement into the 227, which is a 76.4 fib. But from a wider perspective, I do think that this area here is going to be a bottom, whether we've seen it at the moment or whether we pull back into a deeper retracement. I think that by and large, this move that we're seeing at the moment is a retracement before the bulls come back into play for JP Morgan. Next up, let's look at Goldman Sachs. So we can see here, oh, sorry, this is UnitedHealth. There we go, Goldman Sachs. So in terms of the breakdown here, how does this sort of differ? Well, ultimately, you're looking at an expectation of a very strong 2024, a really strong 2025. Again, another good 2026 and 2027. So that's really high expectations in terms of growth on an earnings perspective going forward. And that is reflected to a large extent by revenues as well. So there's high expectations as we move forward for the coming years for Goldman's. When it comes to earnings per share on a quarterly basis, you can see 816 in terms of Q4. That's well up from the 548. So you can see the kind of rapid growth expected. Up to 1212 next time around expected, and you can see previously that was 1158. So strong growth expected on the EPS on a quarterly basis, and in terms of the revenue side of things, 1230, that's up from 1132. So strong growth expected across the board when it comes to annual gains in terms of quarterly gains. And what else can we see? Well, we can see the outperformance as highlighted by these surprise figures. So in terms of EPS over the previous 5 quarters, we've seen strong outperformance, particularly on 3 of the 5, but we've seen that outperformance in terms of against estimates on all 5. In terms of revenues, it's a similar kind of story. We've got the last 6 where we've seen outperformance versus market expectations. So by and large, things looking very strong here when it comes down to JP Morgan. And then when we look Goldman Sachs. And then when we look at the chart, we can see it looks very similar to that previous chart that we're looking at when it comes to JP Morgan. That same kind of positive correlation with the 10-year, then it moves into inverse correlation, now moving into a positive correlation. So the gains in the 10-year coming side by side with strength for the asset. So if we look in terms of the recent pullback, it's taken us into the 61.8. We're rallying, so looking very similar to its counterpart. Now we've pulled back into what looks like a deep retracement at the moment, starting to see the bulls coming back into play once again. If we start breaking through swing lows, this is 565, then it looks like we could come into a deeper retracement here. But until then, this pullback looks like a potential opportunity. And certainly as we move into an earnings season that is going to be front run by the big banks, well, so there's likely to be a focus on how this company is likely to benefit from the environment that is currently in place. Now, finally, let's talk about UnitedHealth. Now, UnitedHealth, of course, has suffered recently. The assassination of their CEO certainly putting them in the headlines, and it hasn't just put them in the headlines. I mean, it's also shone a light on some of their practices, right? And so there's been question marks about denial of coverage for some of their clients and their customers, and a group of shareholders are pushing back now, and they want to see a review into this. Now, of course, that is only right, and you don't necessarily want insurance companies just constantly pushing back against people when they have justified claims. So certainly the outcome from that and whether it changes the way that the company does business will be really key going forward. But it's worth noting, if you can look here in terms of the outperformance versus market estimates in terms of the yearly EPS and revenues, these businesses, insurance businesses, are absolute money machines. And if we were looking back over previous quarters when I was providing these sort of outlooks in terms of the earnings reports, we were talking about insurance as being the big outperformer against the rest of the financial sector. And so this is a company within an industry that generally has done really well over the years. And certainly we can see that on the yearly basis, and we can see that on the quarterly basis. every single quarter within this screen has outperformed on both revenues and earnings per share. And so there's an expectation that they'll probably outperform once again. We don't see massive drastic outperformance in terms of the percentage terms. But certainly, you're looking at a company that by and large is likely to outperform given everything that we're looking at here, and has just come off the back of a really significant decline around the assassination of the CEO, and some questions around their practices. Whether we're going to see them change their practices remains to be seen. But certainly if we're looking here in terms of the chart, it's a very interesting one. It's the weekly time frame that I'm showing you here with the lows back here in 2020. Showing you this lovely uptrend. It's an incredible chart. And this recent pullback has taken us right into that ascending trend line. Let me just see if we've got a nice deep fib level as well. We got 76.4. Yeah, we do. So 76.4 fib, ascending trend line is come into that confluence absolutely perfectly, and now we're popping, and we've got something like 20% upside from here to the prior highs. So yep, 20.5%. Well, I haven't drawn that perfectly. There we go. So this does look like a potential turnaround story that's likely got legs. And certainly when we look at these earnings, they're probably going to point towards more of the same, right? More outperformance against estimates, and just highlight just how solid the business is as a whole. If we're looking at the trend over the intraday time frame, we can see this sort of ascending trend line. So we're gradually moving higher these lows. And so if we're looking down below, what levels would it take for us to start asking questions of this recent recovery? Well, this 509.7 level would be that. And until then, I think it's likely we grind high, we continue to climb and regain ground as we head into an earnings report that historically has always been beneficial for this company. They ultimately managed to massage expectations to the point where markets are generally feeling positive about the way that the direction that the company is going in. And, we've seen this massive bit of volatility over some of the recent news around this company. But, certainly that confluence of trendline and Fibonacci support points towards a strong possibility that the bulls come back into play from here. I hope that's been useful. Make sure to follow us, like, subscribe, and we'll be providing weekly videos into earnings season as we move throughout the coming weeks. Thanks a lot. My name is Josh Mahony, Chief Market Analyst at Scope Markets.